Pidilite is a stock in focus because relative to the higher estimates that were there as consensus, the company's come out and on most line items beaten those as well. Marginally at that, but beaten those numbers. Mr. Bharat Puri joins in to talk about his sense of what happened in the first 9 months, in Q3, and what is 2024 hold in store. Mr. Puri, great having you. Thanks for taking the time out. I hope all is well.
All is well and always a pleasure to be with you, Neeraj.
The feeling is entirely mutual, sir. Let's talk about the quarter because a lot of things seem to have gone right. On the revenue numbers, almost in line with estimates or maybe slightly lower, if you will. Let's talk about the top line first before I come to the standout part, which is the operational metrics.
See, as far as this quarter is concerned, and frankly, if you look at it, the story is very consistent for the year. We've been very clear that we would like to slowly and steadily achieve double-digit volume growth. That's where we're now, where we've reached. Underlying volume growth is at a steady double-digit number. The B2B business has also returned to growth this quarter. Actually, it's grown faster than the consumer and bazaar business because of the return of business. So overall, we've always maintained we will invest in the core, make sure that core grows for us. Growth categories and growth geographies continue to drive growth, and we keep introducing pioneer categories. And all of that, if you look at just not the last 3 months, but the last 9 months, we've been very consistent with that. We're one of the few organizations where over the last 3 to 4 years, we've been consistently investing, for example, in rural and semi-urban markets. You know, our initiative, the Pidilite Ki Duniya, we now have 12,000 Pidilite Ki Duniyas in villages with a population of 5 to 10,000. We've increased distribution points just this quarter by another 30,000. Our investment in both increasing our range, educating consumers, and obviously increasing distribution touch points is, you know, for us, rural and semi-urban is growing 1.5 times urban, which is therefore leading to growth. When we look at innovation, that's been a strong driver of growth. Last time when we spoke, Neeraj, in fact, more than a year back, I told you we've been ready during the COVID period with our innovation calendar for the next 12 months. Now that has started rolling out. Every division has rolled out new innovation. That's been a strong contributor of growth, all supported by two things. One is a very strong digital infrastructure. And the second is our supply chain. We've opened 9 factories this year, one more this quarter. We now have over 70 facilities, and we're clearly ready for the next phase of growth.
Okay, and I'll talk about this, but just one quick question, and I just want to get this sorted. Is our assumption about or our math around the difference between volume growth and value growth correct? That volume growth has outpaced value growth. The last 4 quarters, value growth, single digits. Now, is there a reason why this is happening? Do you intend to change this, or are you happy with the way the thing is right now?
No, it's a very simple reason we're reducing prices. If you remember last year at this time, we were like, you know, under the weight of a very high raw material price. VAM was at $2,000 a ton. It's now returned to normalcy to $900 to $1,000. And we're passing on benefits back to the consumer. It's really therefore price reductions. For us, the clear metric for success is underlying profitable volume growth. That's what we are focused on. Raw material prices will go up and down, and therefore you will adjust price. But as long as more volume is going into the hands of the consumer, you're either adding new consumers or existing consumers are using more. And to us, that's the clear metric that if we, you know, can grow that in double digits, we're adding 10% new consumers or existing consumers doing more every year.
Point well taken. The other aspect is something that you had alluded to in all the conversations around VAM prices and what that could do to margins. Some bit of that, or rather a significant bit of that, has played out as well. Would you reckon more is in store or continuation is in store at these levels?
See, these days, Neeraj, you and me know we live in these uncertain times where geopolitics has become this new feature. So again, barring any black swan, unforeseen circumstances, we do believe raw material prices will remain stable. I can at least say that for the next 3 to 4 months, then we will see. So we've always guided our margin range is 20 to 24%. When raw material prices are benign and stable as they are now, it will be at the higher end. When they are volatile and a little more uncertain, it will be at the lower end. So we're in that range, and as we take a step back, obviously our next step is now to see how do we invest back further into growth and keep pushing back into double-digit volume growth.
So here's my question. I hear you talk about starting so many facilities, manufacturing facilities, one more coming up, etc. I'm guessing it's not that the capacity utilization levels are sky high currently. So how does, but you are foraying into newer categories, as we all know as well. I'm trying to understand, as you think out for 2024 and 25, let's say the next 24 months, what's the utilization levels that you anticipate, and as a result of that, do you anticipate the need or the urge to put more capex into play for fueling future growth, or now the strategy would be to consolidate what you've put up and be light on capex for the next 24 to 36 months as you see demand pick up?
See, in our business, what we always do is the moment we get close to 70 to 75% capacity utilization, we start planning new facilities because we always leave enough headroom for growth. And obviously, a new facility takes time to ramp up. But as we speak, no, while our capacity utilization is at a decent level, we're continuously planning for growth. So next year, again, I mean, you may not see 9 factories, but you will see newer facilities which are currently actually under planning and under construction come up. So on a consistent basis, we estimate GDP growth. Based on that, we estimate core categories growth, and we identify pioneer categories which will become growth categories. And we have a capex program. We continue to spend between 3 to 5% of our revenue on capex. So if you look at the last 3 years, we would have spent, over 1,500 crores just on new facilities. And all of that is now leading, for us to be future ready as well as ready for the next phase of growth.
Okay, you do anticipate the need to do future capex based on your estimates of GDP. Corporate is a best example of, and Automat as established as you, the best example of what could growth look like. You're confident of growth for the next 24 to 36 months?
Absolutely, yes. We are believers in the India growth story. I think the India consumption story is still playing out. We're also very fortunate to be well positioned in the right sectors. If you see India's housing stock, we still need to, build massive amount of housing stock as far as India is concerned across income groups. Infrastructure, while it's being built, we know it's a 10-year roadmap, and therefore there's a substantial amount of infrastructure which leads to its own demand as far as our products is concerned. And to all of this, if we do see the manufacturing 2.0 or China plus one, whatever it is called, that's another driver for growth. So we are making sure that we are ready for that phase of growth.
This whole 2023 has been punctuated, at least by conversation around the K-shaped growth yet, but even in the upper end of the K, the upper crust or premiumization being the buzzword. I would love to understand from you, whether for your categories or for consumption at large, how do you see the next 12 to 18 months? Could that still be the defining factor, or do you reckon the nature of consumption will change? While premiumization may do well, could non-premium products make a bit of a comeback? How do you see this space for your products and for consumption in general?
See, for our products, Neeraj, we always follow what we call a 3 Indias approach. There is a premium India, there is a middle India, and there's an aspirant India. Any organization that wants to be national and wants to, be a leader has to have an offering across all 3 areas. Yes, definitely the premium area and the middle area has been growing well for most organizations. But as far as Pidilite is concerned, actually for us, all 3 are growing at good rates. And, largely, as I told you, because a large part of aspirant India falls into rural and small towns. For us, the investment into these towns, the investment into consumer education, our categories still, unlike, say, a food product or a soap, where you don't have to teach people how to eat, say, a toffee or use a soap. In our case, we have to teach them how to, put broken things together, how to waterproof their home. Therefore, we see a greater runway for growth across all 3 sectors. We don't see A and B growing much faster than C. The premiumization trend is a definite trend. We are seeing, premium India emerge, which was not there 5 or 7 years ago. There is a definite premium India. Middle India still remains the largest part of India, and aspirant India, if you have the patience and you make the investments, we definitely see the returns.
Sorry, for not your products, but for consumption in general, premium India grows faster, you think, or aspirant India makes a comeback?
I think over time, Aspirant India has to make a comeback.
Okay.
There is no doubt if India's growth, we has to step up from the 7.5, and maybe go to 8. Then Aspirant India has to play a larger role.
Got it. Mr. Puri, always fantastic talking to you, but I look forward to now, before the end of the financial year, talking to you from one of your facilities. So we'll try and do that before March ends. I hope we manage to find the time with you. Thank you for taking the time out and speaking to us today.
Definitely. Always a pleasure, Neeraj. Thanks so much.
Thank you for your time, and viewers, thanks for tuning in.